I suppose the outlook for rates, obviously, we'll find out next month. But some suggestions, look, inflation trending where it is at the moment, very moderate, very contained. Overseas, there hasn't been a big drop-off, if you like, that many had, thought might be the case. So why not stay on the sidelines, reassess in March and then move?
Yeah, I agree with everything Jeff said. I think there was a bit of hyperbole over some of the numbers. Very much on what Jeff said in terms of correcting on previous figures. Obviously, food was down after being up 2.5% over the year, so it was largely a sort of a correction. But I guess looking at it in a more general sense, Melbourne, Sydney, Perth are three of the most expensive cities almost in the world now. So whilst we may have had a good month of inflation, Australia's a very expensive place to live. But I guess then drawing to your question about interest rates, and again what Jeff said is spot on. The reason for the recent cuts hasn't been domestically driven, it's been globally driven, and the fears over Europe, they certainly haven't abated. But I think just flicking back again to what we discussed several weeks ago, whilst the RBA has got the firepower to drop rates, whether that's a wise move is another question entirely. Whether the majority of Australians or the Australian economy as a whole benefits from lower rates is certainly a question that isn't answered so simply. A lot of people simply assume that lower rates are better because the 33% of mortgage holders, 33% of homeowners who have mortgages pay less. But that's not necessarily always the case, because there are a large group of savers who are worse off. And business, whilst lowering their borrowing costs, other businesses prefer higher, financial institutions often prefer higher rates. So simply lowering the rates as some sort of panacea for economic woes isn't always the answer. The US has had 0% rates and their economy certainly hasn't improved.
Well, that's a good point you make, Adam. I mean, is there much evidence to show it works? I mean, you look back at that Westpac consumer sentiment read we got out, I think, a week or so ago, and that came after the rate cuts that we saw in both November and December, and with the outlook being very much for more cuts this year. And we saw no real, there was a little bit of an uptick in January, but the broader picture still was of a very subdued sort of consumer sentiment, subdued confidence. We're still seeing deleveraging of a lot of home balance sheets and so forth. Consumers aren't spending.
Oh, you're spot on, James. And Australia, like the US, Australian households have been acting very responsibly in the last couple of years since GFC. They've toned down their spending. Instead of, Australia had a net savings rate which was below zero, so we spent more than we saved. That's just obviously unsustainable. And what many Australian households have done, and very shrewdly, is their own little mini austerity. So Australians are living within their means, which is a good thing. It's a bad thing if you're a retailer, but it's a good thing if you're a nation, because we're living how we should, living within our means. And it's, I guess, the beauty of a higher interest rate regime is that it encourages people to save, and that saving gets used for increasing productive capacity. So instead of supporting spending, which is what lower interest rates do, if you look at China, for example, the reason why the property market in China has increased so much is because you put money in a bank and you're actually losing money by the time you look at the real rate you're getting. So if you're a Chinese person, you're better off speculating on some asset like property, or until last year the share market, rather than saving, because if you're saving, you're actually losing money. So there is certainly an advantage to having a higher interest rate regime, and that's, as you've seen with the Australian dollar, money has been flowing in through the carry trade because of our higher rates. Whether that's actually a good or a bad thing is another question, but that certainly is the case.
Jeff, I suppose we start with you. Look, obviously, he's a fantastic speaker, Barack Obama, well known for it and so forth. So in that regard, he generally gets top marks. But what about the message? I mean, this was very much a campaign speech for a second term for the Obama administration. In your opinion, did he hit the mark?
I agree, James. He's such a great speaker, but he's been saying the same rhetoric for the last 3 years. And I guess, Obama's offence, he inherited a complete basket case from the Republicans. So it's not necessarily his fault, but the US has been running a humongous budget deficit, has increased substantially under Obama. He's continued the war. Well, he's finally pulled out of Iraq, but there's no pulling out of Afghanistan. It's a costly, incredibly costly war that the US simply can't afford. There's bases all over the world that the US can't afford. Whatever you think about the US's foreign policy, and I'm not even talking about the political side of it, simply the economic side of it, it's simply unsustainable policy. They run a humongous, inefficient terrible healthcare system over there. The highest earning American city is Washington DC, which is just laden with public servants. So the US has this huge bloated public sector. As we discussed in the last segment, like in Australia, the US private sector has been responsible in paying down debt, whereas the US public sector has been taking on this debt. So whereas the US households have been relatively responsible, and part of that's been cast on them by their huge unemployment, it's the US public sector, which eventually Obama is in charge of, that has been leading the anti-austerity push, so to speak. It's been huge stimulus push through, and Obama talks the talk, but he hasn't been willing to walk the walk.
Jeff, it's going to be the US Fed meeting we had earlier this week as well. No surprise, I suppose, interest rates remaining around about zero, though suggesting maybe caught the market a little bit by surprise. They'll do so likely through 2014, but also some of the commentary on potential stimulus. A lot suggesting that they basically said the door remains very wide open. There is a likelihood of QE3 should things worsen. I suppose it's pretty much what they've been saying for a while, but they seem to be a little bit more aggressive.
Certainly, James. Any sort of monetary hawk would be very concerned and has been concerned by Ben Bernanke's stewardship of the Fed. Greenspan, ironically, was a relatively from an Austrian and Ayn Rand background back in the day, but he certainly lost the plot in the early 2000s and arguably was the man most responsible for the GFC. And Ben Bernanke's certainly taken on the role with a plump. Man they call Helicopter Ben, because his plan is to print money at the first sign of weakness, and he's certainly done that in QE1 and QE2, and it certainly wouldn't surprise anybody if he did it again. And I think if you look at the gold price at above 1,700 now, that's just what the market thinks of Ben Bernanke, that real money, gold's been a store of value for thousands of years, is telling you what it thinks of the US Fed and the US government and their ability to balance budgets. And quite simply, one of the main reasons that Bernanke isn't raising rates is because the US simply can't afford to pay interest on its debt. It's got this huge debt owing, and if interest rates are at 4 and 5%, the interest bill is massive. So that's one of the key reasons that they've been so tepid in raising rates. And if you look at historically, the real rate of return should be around 3 to 5%. And it's zero. So it was negative actually because there's inflation. So it's not a long-term policy that can be maintained. It's a question of how long the US can continue this status quo without their creditors finally seeing through the charade.
We're going to have to quickly go. Be doing enough, and what they are doing, is it right? I mean, they get a lot of criticism, but at the same time, they are somewhat hamstrung by what they're allowed to do, particularly from, I suppose, that constitution, and particularly from what Germany will allow them to do.
I'm not in complete agreement with this necessarily being a great thing, certainly in the long term. I think the Germans do have very long memories of the 1920s and Weimar Republic, and we saw what happened when there's widespread money printing and the destruction it causes to society. And obviously that was a leading reason for Hitler's rise. And virtually every country that's had widespread inflation has suffered a similar fate. And what the ECB is effectively doing is some backdoor money printing. And it sure alleviates a short-term issue, but it does create a long-term problem down the track, and eventually inflation will come. There'll be an initial bout of deflation, as we've seen, but eventually inflation's a simple increase in the money supply, and if you're printing money, you're increasing the money supply, and eventually that will feed through to higher prices. So whether it's what Bernanke's doing and what the ECB is doing is a good thing, it may alleviate paper over some short-term cracks, but it doesn't necessarily solve any long-term problems, and that's simply that Europe has lived outside its means and continues to do so. And if you look at a country like Greece, they're talking about austerity and bailouts and the like, and Greece has just announced a 10% GDP deficit. This is a country that is just incapable of living within its means. The whole world is looking at them and saying, you've got to behave yourself, and that 10% deficit, they're just completely incapable of managing an economy, and this is what the ECB is printing money for. It's a disaster. The whole of Europe's a disaster. They can't simply live beyond their means forever. And it's not a question of austerity. It's almost a question of just common sense. You can't spend more than you earn. And Europe's been doing it for years. They're welfare states like France and Italy and Greece just aren't sustainable. And Germany will only put up for it for so long, because Germany is one of the few that actually operates correctly.
So, Adam, when you say that Germany's only going to put up with it for so long, do you think that Greece's position within the EU is endangered, or if they go, is that really just going to cause more problems?
I've been an EU sceptic since day one. I don't think the EU should ever have been created. It's a nonsensical economic fiction, joining completely disparate economies into locking them into fixed monetary policies and not giving them the ability to devalue their way out of a troublesome situation like Greece should have been able to do. So it's like many, I don't think that the EU is a long-term sustainable option, and it's been borne out now.
I suppose
and the disparity. Sorry.
Yeah, go ahead, Adam. Finish what you were saying.
The disparity between the north and the south of Europe is simply something that can't be put together. It's not a United States. It's a very different being.
Just on that, Mario Monti, the Italian PIM, I think obviously we've been question marks over its joint venture Browse LNG project for quite some time. Stories particularly out of the Oz that they have received expressions of interest for an equity part, if you like. Woodside coming out and saying, look, responding to this media speculation saying, you know, we do have a process in place to look at a potential sale or part of it. I mean, are they going to sell down, do you think? I mean, is that pretty much a fait accompli?
Well, it's sounding like, well, I was not too familiar with this greatly in depth on this issue, but from the brief sort of info that we've got, it sounds like they're looking that way. And Woodside's a company that's just so inextricably linked to the oil price. Its share price is almost just perfectly correlated with the oil price. So whatever sort of Woodside management does is almost irrelevant because the company is so dependent on something outside of its control. But yeah, so it's obviously got a lot of developments in the pipeline and Pluto and several other key assets, and it's a company that's just so wedded to the oil price. And if the oil price stays high and continues going higher, then it's a good investment. And if not, then less so.
Ian, it's looking here in Australia. Is it a case of just flicking to the back pages for that guidance? And you're hopeful that we might get a little bit more from the CEOs. I mean, last year they were incredibly guarded to the point where they could have just pretty much issued a blank sheet of paper.
Well, personally, I don't like to listen to what CEOs say anyway, because I don't think they necessarily are in line with investors, what investors should be hearing. In terms of what the earnings season will bring, well, the economy seems pretty tepid in the last quarter. Retail especially is down, but that's been well and truly factored into share prices there. Obviously, the mining sector is still doing reasonably well with great production numbers. And commodities obviously did drop substantially, but are picking up a little in recent times. But the Australian market has been very subdued lately. I think everybody's quite gun shy from several years ago. And if you look at it, we've still got record low unemployment, or near record low unemployment, certainly in the last 2 decades. Virtually full employment. That will almost certainly worsen. So if you're looking at where the economy will go, we've got property prices that are still in bubble territory, albeit they've come off about 5% in the last year. There's a lot of potential negatives for the Australian economy in the next year. So to forecast sort of bullish earnings or great things going forward, that's contradicting what some of the fundamentals seem to be saying on a macro sense.
Ian, what about you?